Good morning. Magandang umaga po. We are going to talk about how you can invest your money when you retire. That's what we'll talk about today. Stay with me. When you retire, the idea is you don't want to work hard. You just want to live off your pension, Social Security, and what other income you'll be able to get without exerting too much effort. Now, obviously, for some people, they cannot really retire. In effect, they're forced to retire. So they retire from their job and they look for secondary job or part-time job or temporary job or whatever you call it. That's not what we'll talk about. We'll talk about a situation where you retire, and let's take a look at a chart. You have certain monthly expense, but then you have certain pension and Social Security, and it's not quite enough to cover your expenses. Obviously, if your pension and Social Security every month comes in, and that's regular, that's not affected by anything, and your expense is less than what you're getting, you can retire forever. You don't even need savings. But sometimes you do. But now, the situation usually is that this pension and Social Security is not enough. So what do people do? Sometimes they try to reduce their expenses by buying a smaller house, reducing their expenses in order to fit their pension, their monthly pension and Social Security benefit. But what if you can't? You have certain expenses and you're not receiving enough pension and Social Security. So what do? Well, you look for added income. And when you look for added income, because they will never be exact, hopefully it is more than your total expense, the difference goes to savings. So now comes the question, what do you do with that savings? Let's continue. So let's say you have accumulated savings. Let's say from the time you were a teenager or middle age, you were able to save some money. Okay? Now, comes retirement, you get additional investment yield, and then you have withdrawal every month for your expenses, living expenses. If your withdrawal, this is ideally, your withdrawal should be less than the investment yield. You should be making more money than what you're spending. And if you do that every year, your accumulated savings will be growing and it will never be depleted at all. So you're secured. You're okay for life. So investment yield is very important. So what do you do? Where do you put your money? We're going to talk about the different kinds of investment. I'm going to show you the different alternatives. The first one, for example, is high-yield savings. If you can find the right high-yield savings, the rate that I'm quoting here is not necessarily today's rate. It could be higher, it could be lower, depends, because this thing changes every day. And for example, Marcus by Goldman Sachs was paying about 1.5% to 2% on a high-yield savings. Was, anyway. Check it out, what it is now. But these are not the things we're going to talk about. I'm going to talk to you about what the focus of our discussion is going to be. TIPS, it's called Treasury Inflation Protected Securities. That's protected by U.S. government. You could buy 5, 10, 15, 30-year bonds, but the longer the length of the bond, the life of the bond is, the higher is the interest rate, and that ranges from 1.5 to 2%. Short-term bonds, for example, Vanguard, BIV, that's about 2.5%. So you can just look at the relative rates. No, don't look at the rates as an absolute rate that you will get today. But say if short-term is 2.5%, TIPS is probably about 2%, high yield is probably about 2%. So look at it relative to each other. Dividend-paying stocks, for example, utility companies. Their appreciation usually is not much, but they do pay dividend. And some people want the feeling of receiving something every month, just like in savings. So how much interest did I get today? How much dividend did I receive today? Examples are Chevron and Verizon. They pay about 2.5% to 4%. Now, in my view, I always look at the total dividend I'm receiving and the appreciation or depreciation in value. You may be getting 4%, but if your holding is coming down by 2%, in effect, you only made 2%. Or if it comes down 3%, in effect, you only made 1%. So I look at both. Preferred stock. And preferred stock could be preferred as to the asset or dividend. Preferred stock that's preferred as to asset means if there is a liquidation of the corporation, gets liquidated, you are the first one who will receive the proceeds before it's given to common shareholders. So two types, preferred and common. So the preferred stock is preferred either as to the asset in case of liquidation or dividend, meaning they will receive dividend first before anything is given to the common shareholders. Usually, preferred stocks do not have voting rights, meaning any decision, major decision made by the corporation that requires members to vote, they will vote. But if you're a preferred shareholders, you don't get to vote. But if you don't care about those things, you just worry about the returns you're getting on your investment, that doesn't matter. For example, I owned shares before, but I never voted. To be honest, I never did because I don't care, because I don't really know who they are. Although they issue out a prospectus talking about background and such, I don't bother with those. An example of this is Alcoa. They pay about 5% to preferred shareholders. Now, recently I bought some stock in a utility company, and it's paying some dividend, but the valuation is steady. It's not coming down, it's not going up. But recently, it's going up a little bit, so I'm encouraged by that. But I thought I would just test preferred stock. Well, no, I'm sorry. That's not a preferred stock that I bought. I bought a common stock, but it's a dividend-paying common stock. Annuities. I'm not too hot on annuities. Be very careful. When you're young, usually this is for a period of time, annuities. So when you're retired, you only have a few years to go. Why will you invest in annuity? And you have to be very careful, and you have to read the fine print. It could be fixed, variable, or deferred annuity. Money is held for a long time, okay? And if you withdraw before the maturity date, you give up some principal, so you may even lose money for penalty when you withdraw sooner than the maturity date. And also sometimes, maybe I should say frequently, it has some insurance feature. And the problem I have with this is it's like a come on. They will say, oh gee, you invest in this and this is the return you're gonna get, and guess what? In case you die, here is an insurance proceeds. So they're not really splitting how much you're paying for insurance and how much you're paying for the annuity, meaning the savings feature of an annuity. And when I look for a term insurance to see, for example, if I want to be insured 1 million, if I look for a term, strictly term insurance, no annuity, no whole life, just term, I compare that and I say, okay, so if this is the value of the term insurance and I deduct that, what they pay you in an annuity is not much at all. So, but by blending it together, you get confused and you don't know how much it's really costing you. Now, my favorite. See, either you invest in stocks. Stocks gives you ownership of the corporation. You own the corporation. Bonds, the corporation owes you, meaning you're lending money to the corporation. That's a bond. When you invest in stock, you own part of the corporation. Mutual fund is a group of stocks or group of bonds, but not a mixture of both. Okay? I'm going to explain that further later. Now, the yield depends on the fund, the mix of stocks and bonds, and the risk. And when I say mix, it's because it's multiple stocks. For example, you invest in Amazon, that's all you own. If Amazon goes down, you're dead. If Amazon goes up, you're king. Okay? But in a mutual fund, they own Amazon, Microsoft, Google, blah, blah, blah. So if Amazon drops, you're not hurt too much because your investment is also in the other stocks. So we'll talk about that more in greater detail. Yield depends on the fund mix of stocks and bonds and risk. Low risk because it's in multiple companies. High risk if it's investing in high risk ventures. Low yield, high yield, balanced fund. So each fund is defined as to where they're going to invest it. Will they invest it in stocks or bonds? Will they invest it in international companies or domestic companies? Will they invest it on emerging business, meaning it's just starting up, or stable business like IBM, Exxon, things like that? Will it invest in Chinese companies, for example, stocks? They define what kind of mutual fund that is. So you can make your choice in that respect. Lending club. They range from 5 to 7%, but usually you have to wait a long time. They call it crowdsourcing with real estate investing. I'm going to explain that further. Notes investing. Now, I'm not too familiar with this lending club, but I tried to do this myself when I was still younger. And basically, what I was doing is I said, okay, by the way, I just considered this, but I did not really pursue it. I want to finance, if somebody approaches me, they want to buy this house, I will finance it. I will pay for the house, right? That they will issue me, they will give me a promissory note that they will pay me at a later date, which is basically the same thing they're doing if they approach a bank. But instead of approaching a bank, they approach me. And then I will have a note, which later I can discount and sell to somebody else so that the note now belongs to them and I get the proceeds right away. And who uses this? These are people who generally are high-risk lenders, or not lenders, but borrowers. For example, if their credit is bad, they cannot get it from a bank, they will try to get it from an individual. I call this thing mafia sourcing. But anyway, they of course pay high interest rate. And the reason is it's higher risk because you're lending to people with poor credit score, for example. If you investigate somebody, maybe they have poor credit score because they run into some trouble. But before that, maybe they're diligent payers and they're okay. They have good credit score from your eyes, okay? And that's what they do. Why did I not pursue this? I did not have the capital. Nice dream. I learned something from it. But I did not pursue it because you need a lot of money to be able to do it. You're a lender. I call it mafia sourcing. And I think this is the last one, fund rise. It's about 7%. Good fit for investors looking to make long-term investments in illiquid assets, meaning assets that cannot be converted to cash right away. Dividend payout from real estate investments. Okay? Offer features similar to electronic real estate investment trust, REIT, right? REIT, they call it the REIT, real estate investment trust. I never got involved in this because my interest was more in the stocks and bonds and mutual fund. Now, let's look at where you can put your money. You can put your money in checking savings account, CDs and treasury bonds, stocks and bonds, mutual fund, which could be either stocks or bond, or real estate. Now, checking and savings is very liquid. Almost everybody is familiar with this because you go to the bank and put it in a savings account or checking account, okay? It has low interest rate. I don't know what it is now. It used to be almost zero. Like 0.01, 0.02. That's like 1/10 of 1%, or even 1/100 of 1%. Low interest rate, and then there are high yield account, and they say 1 to 2%, but that's not with a bank. You have to go somewhere else to get that. Could withdraw anytime without penalty. That's the beauty of that. Anytime you need it, emergency or non-emergency, you can get it. That's why it's a good temporary parking. I have savings account, but I keep it at a very minimum. And then that is insured by FDIC. Who cares about FDIC insurance if I'm guaranteed to lose money because I'm not getting any substantial interest? CDs is next best thing to savings, but you tie your money up for a little bit longer period of time. So it's not as liquid as savings account because you're reluctant to cash it in, because if you cash it in before maturity, you lose some of the interest. Could lose interest when withdrawn prematurely, higher interest rate than checking or savings, insured by FDIC. And this will depend on if you get a 1-year CD, 2-year CD, 5-year CD, 10-year CD. The longer it is, the higher the interest rate is. Now, there was a time when the shorter CD had a higher interest rate than the longer ones. That means they are probably projecting that the interest rate will come down. So obviously, in that case, you just buy a short-term CD. Now, some stocks and bonds are fairly liquid, but they say here somewhat illiquid because you could lose due to market fluctuation. Actually, when I want to sell my stock today, it sells immediately. You don't have to wait like real estate. You have to wait. Here, there's always a buyer. But the reason I say it's illiquid is, what do you do if the stock market is momentarily down and you need the money? So you'll be reluctant to withdraw it because once you sell it, you realize your loss. But if you let it sit there, it could come back up in a little while. So you will be reluctant to do it if the market is down. Some of them have high dividend, some of them don't pay any dividend, high growth, or both. Usually in stocks and bonds, you are after the appreciation in value. Now, mutual fund is sort of somewhat illiquid also because mutual fund, just like a corporate fund, corporate bond or stock, is the same thing, but except that it is a group of different stocks or bonds. For example, as I mentioned earlier, if you buy Amazon, that's all you own. If you buy ABC mutual fund, and then you look at where do they invest my money, and they will say, we invest in IBM and big companies. So it's spread over several stocks. If you are a millionaire, you don't need a mutual fund. You can invest in multiple stocks and you have the same protection as a mutual fund. But there are not too many people who are millionaires. It's more stable than stock because the risk is spread over several stocks and bonds. One thing you have to remember, they go up and they come down. They go up and they come down. They fluctuate. Invest in high dividend, high growth, combination of both. And it's generally not insured by FDIC. Well, not generally, but it's definitely not insured by FDIC. And of course, the last thing we have here is real estate investing. It's not liquid at all because you have to wait to find a buyer. And secondly, for settlement to happen before you receive your cash. Value is also subject to decline, but less than stock. In general, over the long term, real estate always appreciates. Bonds and mutual fund due to leverage, could enjoy its utility, meaning if you own the real estate, you will enjoy the use of the real estate, but rental management could be problematic, meaning if you want to rent it, you have to consider it because we'll talk a little bit about that also. So, the thing that we will focus on in my future episodes is real estate investment, bonds and stocks, and of course mutual fund, which could be stocks or bonds. Those are the things that we are going to cover in the future. But for now, this will just give you an idea as to what you could pursue as an investment alternative. Again, the reason I selected real estate, stocks and bonds, stock or bonds, and mutual fund is because these are the most popular ones and the most practical one if you are retired. The rest, I wouldn't worry about it. should be while you're younger, like annuities and stuff like that. Annuities, which I'm not fond of. Anyway, that's all I have for today. As I said, we are going to talk further on my future episode about these investment vehicles. Thank you so much for watching. I'd appreciate it if you can share this with your friends, and stay with me on the future episodes. Make it a great day, and God bless.